Good day, fellow investors. We recently discussed how long can this bear market last, and there we have had Stanley Druckenmiller's case how the Dow won't be much higher in 10 years than it is today. And there were a lot of comments a little bit frightened about what does it look like to have stocks go nowhere for 10 years. It has happened in the past. Let's discuss because I really see it as an opportunity. And if you think investing when stocks are lower is an opportunity, smash that like button or inflate it to be more in the current situation and subscribe if you haven't. The first thing to understand is that we have lived in a 40-year bull market, the greatest bull market in history, and just for the S&P 500. So if we look at this chart, 40-year chart, the S&P 500 level was 133. Now it is 3,669 as I'm preparing this. So this is what, 25, 30x in 40 years plus dividends, let's say 30x or more, and that is an incredible bull market. Yes, this was 2 years of decline, not even 2 years, 3 weeks of a significant decline, and now we are a few months, 25% down, but still the biggest bull market in history is there. This is, of course, obviously because interest rates since 1982, don't worry, everything is correlated, went nothing but down, and now only in the last few months have we seen this spike in interest rates that has crashed already the market 25%. Everything when it comes to investing is of interest rates, and this was a hurricane, not a tailwind, a hurricane pushing stocks higher. Further, when interest rates could not go lower, then central banks decided let's print the hell out and push financial assets higher, higher, and higher. And that has been the case for the last 40 years, but especially for the last decade when stocks went up 4 or 5 times from the bottom in 2009. That is insane. That is something that will happen likely only once in a century. So it is time to think, okay, what if things return a little bit to the normal, historical normal, how to invest? It is not uncommon that stocks go absolutely nowhere for a decade or even more. In the 2000s, we had a 12-year period of nothing. In the 60s, 70s, 17 years of nothing. Earlier, 25 years of nothing. And 22 years of nothing the beginning of the last century. Of course, here, and here, you had something that changes everything, which were dividends, but now with the current dividend yield at 1.7% for the S&P 500, it is a big difference between going nowhere now for 10 years and going nowhere for 17 or 20 years back in the past. And we have seen these stocks going up for 40 years because interest rates went down. That is simple correlation. However, we must also understand here the difference between real returns and nominal returns. This is, yes, 17 years of nothing, but let me show you something. If we take a look at this chart, the S&P 500 for the last 90 years adjusted for inflation. So here, 1968, the level was 908 points. This is again adjusted for inflation. A few years later, or better to say 15 years later, the index was at 325 points. That is a 60-70% decline in 15 years in real terms. So those who held an index back then lost 70% of their purchasing power by holding stocks over 14 years. And it only recovered, this is 900 points, it only recovered inflation adjusted in 1992. So 25 years of nothing. Similarly, from the dot-com bubble, 2500 inflation adjusted again, it recovered only 15 years later. So we have had this amazing bull run, and it is very, very probable that inflation adjusted, the S&P 500 does not hit the current level for the next 15 years. Of course, if we delete the inflation adjusted, then we have it here. Everything looks beautiful. Stocks only go up except for 25 years here, 70 years here, and 12 years here. But that is a long, long period. And plus, you look at these declines, there are 40-50% declines in the meantime that make it very, very difficult to invest. So it is very, very possible that over the next decade or two, stocks, at least in real terms, go nowhere. And when it comes to investing ahead, even Druckenmiller said he is not saying you can't make money, but you can have a period of 15, 20, 10 years where the market doesn't go anywhere. That doesn't mean you can't make money. You could have made plenty of money in the 70s. We had 260% rallies. So there will be plenty of opportunities, but we have to think about how to take advantage of those opportunities. We already explained the difference between nominal returns. So if the market is flat for the next 10 years, but inflation is 10% per year, that means that we have lost 70% of the purchasing power we had, even if it is flat. And that's something to always keep in mind, that we have to invest in businesses that will do good no matter the environment. Warren Buffett says best businesses out there. But then again, with lower financial assets, finally, after we can say 4 decades of an environment created for gamblers, finally it will be, the time will be ours. We are back to real investing. Dividends, yields, cash flows, reinvested, good returns on capital employed, capital invested, and that's the core of investing going forward. And if you like that attitude, we will discuss that more. We will be the ones buying when everyone else has capitulated. For that, smash that like button, subscribe, and here you have a dividend video that explains how dividends are the core factor for investment returns. Not the Fed, not anything else. Dividends and inflation give everything when it comes to our wealth accumulation. So it's a great video to continue on this topic. Thanks for watching. I'll see you in the next video.